Most people hear the phrase distressed mall acquisition and immediately think buy a dying mall cheap, fix it up, make a profit. That's the headline version. But the real process is much more complicated and much more interesting. Distressed and closed malls don't usually trade like normal commercial real estate assets. They often move through default, special servicing, then receivership, then foreclosure, messy title issues, tenant uncertainty, environmental diligence, and months, sometimes years of negotiation before a new owner ever takes control. And that's exactly why opportunities exist. In this video, we're going to walk through how distressed and closed mall acquisitions actually work from the inside. It doesn't happen because of one single problem. It tends to be the result of three forces coming together. The first, over-leveraged capital structures. During the 2005 to 2015 cycle, many enclosed malls were financed with CMBS loans at 70 to 80% loan-to-value ratios. These loans were based on peak valuations. But as retail trends shifted, department stores closed, e-commerce grew, weaker malls lost traffic, values, they started to fall. When that happens, the borrower can get trapped. They may owe more than the property's worth. They may not be able to refinance. They may not be able to sell for enough to pay off the loan, and they may not be willing or able. Tenant sales decline, rent concessions increase, more tenants leave, net operating income falls, and before long, the mall can no longer support its debt. That's usually when the loan gets transferred to special servicing. This is where distressed mall acquisitions really begin, when a CMBS loan stops performing normally. It can be transferred from the master servicer to a special servicer. A master servicer handles normal loan administration, but a special servicer handles problem loans. And that distinction really matters. The special servicer is not a mall operator. They're not trying to reinvent the food quarter year high, with retail remaining a major contributor. In practical terms, this means tens of billions of dollars in loans are being actively managed as troubled assets rather than normal performing loans. For experienced operators, that creates opportunity, not because every distressed mall is a good deal. Most are not. But because special servicers typically want resolution. They're not long-term holders. They're not repositioning specialists. They want to clear the loan from their book in a way that satisfies their fiduciary obligations. That urgency is where an operator can step in. Now, let's talk about the actual acquisition process. A distressed mall deal usually does not happen in 30 or 60 days. A realistic timeline from identification to closing is often 9 to 18 months, and sometimes longer if there's litigation or bankruptcy or title issues. The process generally unfolds in 4 stages. Stage 1, the identification and initial diligence. This is typically the first 1 to 3 months. We monitor CMBS surveillance reports, TREP data, special servicing transfers, court filings, local market news, and properties showing signs of financial deterioration. The first signal might be a loan transferring to special servicing, but that alone doesn't make it attractive. We immediately look at the fundamentals. What are they? What's the trade area? What are the demographics? Is population stable, growing, shrinking? Who are the competitors? What anchors are still operating? What anchors have gone dark? Most deals get screened out early. In this business, you may look at 50 distressed situations to pursue 5 seriously. Stage 2, cautious. Deferred maintenance continues to build. This phase can last months. In complicated situation, it can last years. Stage 3, that's negotiation with the special servicer. This is where the real work begins. We may submit an indication of interest, get access to the data room, review the rent rolls, the leases, loan documents, service contracts, prior appraisals, environmental reports, and property condition assessments. Then we start underwriting. But underwriting a distressed mall is not like underwriting a stabilized grocery-anchored center. You cannot simply take last year's NOI, apply a market cap rate, and call it done. You have to ask, what income is actually durable? What's stable? Which tenants are likely to stay? Which tenants are paying below market? Which tenants are overpaying and likely to renegotiate their rents down? What capital improvements are absolutely required? What's the true cost of stabilizing the property? And at the same time, the special servicer has its own process. Distressed malls may trade at 50 to 80% below prior valuations. That lower basis can provide a real margin of safety, but the discount's only the starting point. The real value creation comes from three things. First, resetting the capital structure. The prior owner may have been crushed by debt based on an old valuation. When we buy the asset out of distress, that old capital structure, it goes away. We're starting with a new basis, a new financing plan, and ideally a more conservative leverage profile. That changes everything. Debt service becomes more manageable. The property does not need to perform like a $300 million asset if we bought it at a fraction of that value. This gives us room, a cushion to invest, room to make mistakes, room to reposition the property over time. Second, addressing deferred maintenance. This part is not glamorous, but it's critical. A new roof section, better lighting, repaved parking lots, updated HVAC, clean bathrooms, improved signage, refreshed common areas. These are not the things that make headlines, but tenants notice them immediately. When tenants have been watching a property decline for years, visible reinvestment changes the conversation. Suddenly the owner is engaged. The property has a plan. Brokers return calls. Prospective tenants, they're more willing to tour. Existing tenants who are thinking about leaving may reconsider. Third, resetting tenant relationships and economics. Distressed malls often have leases that were negotiated from a position of weakness. Tenants may have received rent concessions or temporary deals or below market terms because the prior owner needed occupancy at almost any cost. As leases roll, a new owner can renegotiate from a stronger position, but only if the property is improving. This is where operations matter. You cannot just raise rents because you bought the mall. Parts of the first year. A third risk is underestimated capital needs. Property condition reports are useful, but distressed assets almost always have hidden issues. Fire alarm panels may be obsolete. Roof repairs may become roof replacements. A renovation permit may trigger code upgrades. Underground utilities may be in worse shape than expected. As a rule of thumb, if the building condition assessment says one number, we assume the actual number may be 20 to 30% higher. And then there's timeline risk. A deal that looks close can get delayed by borrower litigation, bondholder disputes, title problems, bankruptcy filings, or court approvals. Meanwhile, the asset keeps deteriorating. The mall you underwrite in month 3 may not be the same mall you acquire in month 18. That's why disciplined underwriting is essential. For investors, the key question is not simply, can this mall be bought at a discount? The better question is, does the operator have the team, the capital, the relationships, and the experience to convert that discount into durable value? Because distressed mall acquisitions are not quick flips. They're operational turnarounds. The acquisition creates the opportunity. The execution determines the outcome. That's how distressed and closed mall acquisitions actually work. From the first signs of distress to special servicing, to receivership, to closing, and ultimately to repositioning. And for the right operator, with the right asset in the right market, opportunity.